Hello there. Today is Thursday, April 3rd, and this is a special edition of the Kluge Wealth Advisory Group Client Monthly Update video. I want to do a special edition here just to keep everybody up to date on what's going on with the markets as well as what's been termed the Liberation Day tariff announcement. So the bottom line is that there was an extremely negative market reaction today to Donald Trump's announcement about incoming tariffs that will take effect both immediately and on April 9th. Markets were off about 5%, which is fairly significant. I know there were a lot of headlines and there was a general very loud media buzz, and I can imagine sitting in your position that you have questions and potentially concerns. So I want to give some viewpoint on this announcement, what it means and what the potential pathways forward are. So the bottom line with this tariff announcement is that there's a key question you have to answer, and that key question is this a permanent policy that's being announced, or is this a negotiation tactic? If this is a permanent policy that's being announced, then things are going to get very tough very quickly. I'm not going to sugarcoat it. It's going to get ugly. Now, I also want to say in the same breath, I don't think that's the case. I think that that very clearly that this is a negotiation tactic, and this is something that is meant to get the discussion started. It may be loud, it may be noisy, and it's certainly unpleasant, especially if you're on the receiving end of some of this tariff announcement, but it is an invitation for discussion nonetheless. So why do I believe that this is a negotiating tactic? First and foremost, this is exactly what the administration has communicated. Both President Trump and Secretary Bessent have communicated that they want to engage in conversation. And Bessent has gone so far as to say that the tariffs announced are a ceiling and not a floor. Also, if you read the executive order that was signed by President Trump in relation to the Liberation Day tariffs, it's very clear that there are provisions where if a country were to renegotiate its trade arrangements with the US, then they would be able to escape the incoming tariffs. Also, it's conspicuous the fact that both Mexico and Canada, which are currently negotiating new trade agreements with the United States, have been left off the list. So I think that there is both implicit and explicit acknowledgement that this is a negotiating position and is not a final policy that's taking shape. Now, if you're on the receiving end of these tariffs, what does that mean? What options do you have, and where does this all go? Well, any country that's on the receiving end of these tariffs has three key choices. They can do nothing, they can retaliate, or they can negotiate. Now, let's look at things through the lens of China. China, and again, with the Trump administration, it's very important to remember that China is ultimately their number one focus. So I'm just going to run through this scenario with you, through the viewpoint of China, pardon me. Now, I do not want to be, don't want to sit here engaging in any mind reading. I do not know what Xi Jinping is thinking. However, I'm just going to put the filter of incentives, and the fact that human beings act in alignment with incentives over my analysis here. So in terms of China, again, they have three choices. They can do nothing, they can retaliate, they can negotiate. I think the bottom line is that, in terms of doing nothing is not really an option. China needs economic growth, both to enrich its population, as well as to deal with a very large housing debt crisis that they're dealing with right now. They need export markets for their products. Number two, they could retaliate. Now, it's very clear from the President Trump executive order that that if a country retaliates, then there will be additional tariffs placed on their goods. That is not going to help in this case, that's not going to help China to enrich its population and deal with the housing debt problem. The third option is to negotiate. Now, this is very likely, in the case of China, going to be a painful process and could be a longer process. But ultimately, concerns on both sides are going to have to be ironed out, and a new relationship is going to have to be formed. And I think ultimately that's what happens. Over the course of the coming weeks, the incentive for each impacted country is to reach out and to figure out how they can get off this list. And in the case of Canada and Mexico, the incentive is to come to a deal that keeps us off of it as well. Now, there's been a couple concerns, that do get raised, that I've had in conversations today, as well as just, frankly, I've seen in the media, and that is around the possibility that these tariffs could cause a recession, or that these tariffs could cause inflation. In terms of the recession, that's why I made the statement up front in saying, look, if this is a fixed policy, then it's going to get ugly. because it will. It will generate a recession. I don't want to sugarcoat it. It's going to definitely be very, very impactful. However, if it's a negotiating position, the impact is very likely to be much lighter. And I think it's important to note that in the executive order itself, there are large carve-outs for certain industries that have big economic impacts in the United States. For instance, lumber is not subject to a tariff. It doesn't matter the source of the lumber. It is simply not tariffed at all. And the same goes with semiconductors. The same thing goes with critical minerals, which you can read as rare earth minerals. The same thing was going to go with copper. So essential materials for two very, very large economic drivers in the United States, home building and the AI infrastructure build out, are specifically exempted from the tariffs at this point. So again, as bad as things feel, I think the administration has definitely thought this through and is wanting to make sure that they're not deliberately torpedoing two big drivers of economic growth. That plus negotiation just makes a recession less likely. Doesn't make it impossible that it's going to occur, but it makes it less likely. In terms of inflation, this is a much easier question to answer. If we look at what the bond market is doing, the bond market is basically saying, look, there isn't going to be inflation from this. There are derivative contracts that allow you to invest, or if you want to say bet, on what inflation is going to be 1 year from now. And the bottom line is that those contracts are indicating that inflation is going to drop. So the bond market, which is very, very good at predicting inflation, because if they get it wrong, the consequences to returns and fixed income is very, very dire. We've seen that in 2022. They don't see this being inflationary. And the second thing that I think really plays into this analysis by the bond market, as well as just in general common sense, is we also saw in the flurry of headlines buried the fact that OPEC increased production today. And you saw a very, very swift decline in the price of oil. Now, according to our own Dr. James Thorne, there's about a 70% correlation between U.S. inflation and U.S. Gasoline prices. And so what we'd be looking at in this situation is that 6 weeks, if the oil prices stay where they are now, U.S. gasoline prices would be dropping, probably to somewhere in the $3 a gallon level, which is going to free up a lot of money for consumers. And that's also not inflationary. So you have an offset to potential tariff inflation in the price of the drop in the price in gasoline. Now, again, all of this is very fluid. And I'm going to have to, of course, make the qualifying remark that I'm going to have to change my mind if when the facts change. So if you're watching this 2 weeks, 3 weeks from now, perhaps my views have completely changed. The other thing I want to point out is that this volatility is part of the process. We've seen this before, and I promise that we will see this again. In the 20 years that I've been a financial advisor, we've seen this. We've seen things like this happen on many occasions. As I think back in time, I think about the 15% correction that happened in the summer of 2023. I think about COVID, the big reaction there. And we can go on and on and on. And the bottom line is that when we've seen this level of fear before in the market, the forward-looking returns 6 months, 12 months, 18 months out have always been very good. Now, that's not a guarantee it's going to happen this time, but it never hasn't happened. And I'm not the guy that's going to look at the evidence and say, despite all the evidence that it has always occurred, this is the first time ever. So I think the right thing to do in this situation, frankly, is to hold or to buy lots. Now, the question of what we're going to do is still open. We have to make some more analysis. We have to take a look at the risks involved. I'm not sticking myself to any course of action here in this statement. But I do want to say is that, although sentiment and indicators of fear do not give you an exact timing. This still could get worse in the next 3 months before it gets much better. That it always has gotten better and it has gotten much better. So I understand that there could be questions, concerns that you want to discuss in more detail or more specific to your own personal situation. So in that case, please book a time through our Calendar app. Call us, email us. We're here to help and happy to have those conversations and make sure we're providing you the perspective that you need. Thank you for your trust and confidence, and we'll look forward to speaking with each of you soon.